With those big six Q1 earnings out, it is time to check in on those big Canadian banks and see just how they did. Hold on to your seatbelts, folks. This is going to be a good one. Canada's big six banks are the largest by market cap, and they make up the core of our financial system. They also have a significant presence on that international stage as well. These banks have a history of weathering whatever the economy has seen fit to throw our way. It goes without saying that these are the banks that have shown the agility to prepare for economic downturns, like that financial crisis in 2008, and of course the coming wave of pandemic mortgage renewals, which will once again test their resolve. Loan loss provisioning will be the one tool they will all have on their utility belts for sure. In a nutshell, loan loss provisioning is the bank's foresight to see future defaults coming their way and setting aside some money to cover those losses. When the economy has dark clouds on the horizon, such as that wave of pandemic mortgage renewals, the bank will increase the amount of money they set aside for these credit losses. It is absolutely in a bank's best interest to set aside more than they need. This way the losses get priced into their financial statements well in advance, and this provides some overall stability to the bank when those losses begin to actualize. Join the conversation. Let us know in the comments if you hold any of the big six. Thank you for your participation. If you love this sort of content, be sure to subscribe for more, and another huge thank you for that click. We will be looking at the main highlights of their 2024 Q1 earnings. Overall, I will say that the banks did much better this time around compared to their 2023 Q4 earnings. This may be an opportunity to be a little more optimistic, but we do have to remember that there are some rough waters ahead, and even with coming rate cuts, there will still be some struggles within the sector. So without any further ado, let's do this. We will start with a Scotia Bank, a ticker BNS. Their earnings per share, they were expected to come in at $1.61. They actually came in at $1.69. Not too shabby. We will start with their earnings per share. They were expected to come in at $1.61, and they actually came in at $1.69, so they exceeded expectations there. The expected on their revenue, they were expected to come in at $8.246 billion. Guess what? They came in at $8.433 billion. Once again, they exceeded expectation on both categories. They do get an overall pass. Their dividends are still $1.06 a share with a yield of 6.426%. So there's been no change this time around on dividends. Their earnings growth is expected to increase by 6.44% per year. If we look at their fair value, according to a discounted cash flow model, that comes in at $118.07. So they're still sitting undervalued by 44.1%. Their current value is $65.98. Analysts have forecasted a one-year price target of $67.35. So that's only a 2.1% increase. I do have a feeling they will probably exceed that. Loan loss provisioning is a general theme for this quarter. And with Scotiabank, we did see them increase their credit loss fund. They took it all the way up to $962 million. This was more than analysts had expected, but it is a good sign that Scotiabank is not being too conservative in their loss projections. Next, we'll look at Royal Bank, ticker RY. Starting with their earnings per share, they were expected to come in at $2.79. It actually came in better than that, $2.85. So they did exceed those expectations. On the revenue side, it was expected that their revenue would come in at $13.448 billion. It actually came in at $13.485 billion. So once again, they exceeded expectations. Overall, they do get a pass. Their dividends still sitting at $1.38 per share. So it's a yield of 4.184%. There was no change this time around on their dividends. Their earnings growth projection is coming in at 2.55% per year. They had a fair value of $199.18. So that discounted cash flow model does paint them as being undervalued by 33.8%. Their current price sitting at $131.94, and the one-year forecast for these guys comes in at $140.40. So they're looking at a 6.4% increase over the next year. Like Scotiabank, Royal Bank also increased their credit loss funding, taking it all the way up to $813 million. I think we can already begin to see the beginnings of a trend here. Up next, we have TD Bank with ticker TD. For their earnings per share, they were expected to come in at $1.93. They actually came in at $2 even, so they did exceed their expectations. On the revenue front, they were expected to come in at $12.395 billion. They actually came in at $13.6 $1.771 billion. So they exceeded expectations there. So obviously they also get a pass this time around. Their quarterly dividends are still sitting at $1.02 per share on a yield of 5.018%. So there was no change to their dividend. Their earnings growth, it is projected to grow by 6.60% per year, which is not too bad. Their earnings growth is projected to grow by 6.60%, and according to a discounted cash flow model, we do get a fair value of $140.79. So that does paint them as being undervalued by 42.2%. Their current price, it is sitting at $81.31, and their one-year forecast is $87.32. So that's a nice looking 7.4% increase. TD has now set aside a cool $1 billion for their loan loss provisioning strategy. So that is absolutely up, and it seems like some of the issues and controversies that TD has had in this quarter hasn't hurt them as much as you almost would have expected. Up next, we have CIBC with ticker CM. Their earnings per share were expected to come in at $1.66. Well, they actually came in at $1.81, so that's not too shabby. On the revenue side, they were expected to come in at $6.061 billion. They beat that. They came in at $6.221 billion. They will also get a pass. Don't worry, somebody does fail, but we're going to get to them in a moment. Their dividends stay at 90 cents a share on a 5.474% yield. There was no change to this dividend. Their earnings growth, it is coming in at 3.47% per year. This actually dropped quite a bit, as last quarter they were predicting 11%, so that's a little concerning. Their fair value comes in at $116.47. That would indicate that they are undervalued by 43.5%. Their current price comes in at $65.77. That one-year forecast has them coming up a little bit, not much, up to $66.92. That's a 1.8% increase. And of course, that loss provisioning increase story continues. CIBC did follow suit, and they increased their credit loss provisionings up to $585 million. Up next, we have Bank of Montreal with ticker BMO. On the EPS front, they were expected to come in at $3.02. They actually came in quite a lot lower at $2.56. So they missed expectations big time on that one. Let's look at their revenue. Their revenue was expected to come in at $8.359 billion. Well, they missed on that too. Their actual came in at $7.850 billion. And this is our only fail of the day. In fact, they're the only big bank to miss expectations this time around. I probably should have threw a spoiler alert on that, because we do have one bank left to go. Their dividends do come in at $1.51 a share with a yield of 4.908%. And once again, no change on their dividends this time around. Their earnings growth is projected to grow quite a bit, 13.09% per year. This fell quite a bit from last time. Their fair value using a discounted cash flow model comes in at $209.21. So that does still paint them as being undervalued by 41.2%. Their current price sitting at $123.07. They have a one-year forecast that's not that bad at $131.21. So that's an increase of 8.2%. As we said a moment ago, BMO is the only big bank to miss their earnings this quarter. They also did increase their buffer for loan losses up to $627 million. Finally, we have National Bank with a ticker of NA. When it comes to their earnings per share, they were anticipated to come in at $2.36. They exceeded that. They came in at $2.59. On the revenue front, they were expected to come in at $2.706 billion, and they beat that as well, coming in at $2.820 billion. Once again, this is another one that gets an overall pass. Their dividends are still sitting at $1.06 per share. It's a yield of 3.973%. So no change there. Their earnings growth projection is 8.51% per year. This went up a wee bit, which is fantastic. When we look at their fair value using a discounted cash flow model, it comes in at $170.63. This paints them as undervalued by 37.5%. Their current price is $106.71. Now, this is the only downside. Their one-year forecast, it's only $108.50. So that's a 1.7% increase. I have a feeling they're going to beat that. I really think they will beat that. National Bank also increased their loan loss provisioning up to $120 million. It is good to see that all of the banks are on the same page when it comes to increasing that protection for those loan loss provisions. Let's check out the total returns for this year to date, because I think that's always kind of fun. This was a little surprising. So year to date, National Bank comes in at number 1 with a 7.5% total return. BNS at 2 at 6.11%. CIBC comes in at number 3 at 4.94%. The bottom 3 are all in the negative. Number 4, we got Royal Bank, negative 0.03%. Number 5, TD, negative 3.48%. And number 6, Bank of Montreal, negative 4.53%. This was a lot of fun, and as you know, this is now something we're going to do every quarter, so I'm looking forward to doing it next time around. As usual, if you are interested in any of these bank stocks today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on CIBC. Thank you for watching, and I will see you in the next video.